Welcome to the deep dive. Today we're plunging into the world of financial markets, and we're comparing two really fundamentally different ways of navigating them.
Right. On one hand, you've got modern AI trading programs, which, let's be honest, many assume are the ultimate edge.
Exactly. But then there's this other concept, race-wide mix, based on something called market rhythm. And our sources pose this question: investing. The one who knows the principle wins, not the one with information. That's our mission today, to explore that.
It's a fascinating premise because, AI seems so powerful with all that data crunching, but these sources suggest maybe understanding the market's basic principles, its fundamentals, offers something, well, more lasting.
A more durable edge, perhaps. So let's get into it. How does RH Mix actually define these principles? What is this market rhythm?
It's built on the idea that markets move in a repetitive, almost natural cycle. Think of it like breathing. Our sources use these terms. Oki, oki, yi, a.
Okay, can you break those down a bit? It sounds like tightening.
Exactly, contraction. Then queries is recovery, like a bounce back. Grikes is divergence, where price really starts moving, expanding out. And correct is the transition between these phases.
So contraction, recovery, divergence, transition. It's a flow.
Precisely, a recurring sequence. And RH argues this isn't just random noise, it's the market of fundamental behavior driven by shifts in sentiment, supply, demand, things that repeat.
That feels very different from how AI usually works, right? AI is more about spotting statistical patterns in vast amounts of past data.
Yeah, typically, AI learns correlations, predicts based on probability from historical data. RH though, it posits this absolute language of market rhythm that AI might miss because it's focused on data quantity rather than the underlying structure or, let's say, the grammar of the market.
Grammar, I like that. So how does RH make this visible? You mentioned AI can be a black box.
Right, and that's a huge difference. RH apparently displays its lines and rhythms directly on the charts. So theoretically, anyone can look at the same chart and see the same patterns, interpret them consistently.
Okay, that sounds much more transparent. You see the why, not just the what.
Exactly. With AI, often you just get the trade signal, the complex reasoning behind it, hidden inside the algorithm. That lack of transparency can be a real hurdle for trust and understanding, especially for individual investors.
That makes sense. And what about adaptability? Markets change, policies shift. RH makes this bold claim: market existence, rhythm existence. The rhythm is always there.
That's the core argument. They're saying because this rhythm reflects fundamental human market behavior, it persists through different events or policy changes. The expression might change, but the underlying cycle remains.
How does that stack up against AI?
Well, AI models often need significant retraining when the market environment changes. New data, new patterns, maybe new regulations come in, and the old model might become less effective or even obsolete.
And they need serious infrastructure, right?
Yeah.
Super fast connections, massive computing power.
Absolutely. Which generally puts sophisticated AI trading firmly in the realm of large institutions. The ones with the deep pockets for that tech and the teams to manage it. RH Mix seems positioned as more accessible, teaching individuals to read the charts themselves.
Okay, this is leading us to the practical side, the results. Our sources mentioned some internal simulations. What did they find about win rates? This is where the rubber meets the road.
Right. The data suggests that using the full RH Mix system yielded an average expected win rate somewhere in the range of 65 to 72% in those simulations.
65 to 72%, that's significant. But what about someone who doesn't have access to the whole proprietary system? What about the average person?
And that's maybe the most compelling part. The sources indicate that even just using part of the system specifically, the publicly available V.P.A.R indicator, which is derived from RH Mix principles.
V.P.A.R, okay, I've seen that indicator. It helps identify market phases, right?
Exactly. Using just that V.P.A.R indicator apparently boosted an individual trader's win rate by an average of plus 15 to 25%.
Wow, okay. So that brings their average win rate up to potentially 55–60%. Just by using one public indicator based on these rhythm principles.
That's what the data suggests. It implies you don't necessarily need the secret sauce or the fastest machines. Understanding a piece of this market language can already give you a measurable edge.
So let's wrap this up. What's the key takeaway here for you listening to this? It seems it's not always about having the most data or the fastest algorithm.
I think that's right. This deep dive suggests that maybe, just maybe, understanding these fundamental repeating patterns, this absolute language the market speaks, could be just as, if not more, powerful.
Learning the market's inherent language.
Yeah, it shifts the perspective. Instead of feeling like you're just battling algorithms, you become, as our sources put it, a player who converses with the market itself.
Conversing with the market, that's definitely something to think about next time you're looking at a chart.